consideration, which is the amount realized from the transfer of capital asset. Followed by this, you deduct the transfer expense. In simple words, it is the expenses incurred in selling the capital asset. So the outcome of these first two steps is called net sale consideration. From this, you have to deduct the cost of acquisition. Sometimes we take index cost of acquisition or we take written down value depending on the type of capital asset. If it is appreciating capital asset, if it is depreciating capital asset, whether it is financial asset, whether it is intangible assets, all these factors have to be looked into. And another important factor that has to be looked into is whether the asset is long term or short term. In case if the asset is short term capital asset, then we go for cost of acquisition. In case if the asset is long term capital asset, then we have to apply the concept of indexing and take index cost of acquisition. In case if it is a depreciating asset, instead of taking cost, we take written down value. And in case if the SSC has done any improvement, any modification, any additions to the capital asset, the SSC can either claim cost of improvement or index cost of improvement, depending whether the asset is long term or short term. So the end result of this is called gross capital gain, from which the SSC is eligible for deductions provided certain criteria are met. So this is what we would be discussing in today's class. What are these deductions? So these deductions can be claimed from gross capital gain, and these deductions are specified under these sections: section 54, section 54B, section 54D, section 54 EC, and section 54F. Well, there are other sections also, section 54G, section 54 GGA, right? There are many other sections that can be claimed as deduction from gross capital gain. But however, in your syllabus, we have only 5 sections which are being included. So we would be discussing all these 5 sections in detail, and we will learn the provisions of all these 5 sections. The purpose of introducing deductions is to help the SSC in lowering or completely eliminating the tax liability, right? On the one hand, income tax department wants tax revenue. On the other hand, it also offers incentives to taxpayers if they meet certain provisions, which is as prescribed by Income Tax Act. So Income Tax Department does encourages tax planning, but what it does not encourage is tax avoidance or tax evasion. So tax planning is a process in which an individual will be able to minimize or eliminate his tax liability by making use of the provisions of Income Tax Act. So that is called tax planning. Whereas tax evasion and tax avoidance is something which is totally unacceptable, because in tax avoidance, you misuse the provisions of Income Tax Act. In tax planning, you use them judiciously, whereas in tax avoidance, you misuse them. You try to find out what are the loopholes using which you can minimize your tax liability. So that becomes tax avoidance. Tax evasion is where you don't disclose your income itself. You don't report the transactions itself. So whatever happens, whatever you earn becomes black money, right? So you people quite often hear this concept of black money. Black money, right? The moment we say black money, that means there are 2 things that have happened. One, the person has not disclosed the income. Second, he has not paid the tax. The moment you don't do these 2 things, it is called as black money. So Income Tax Department wants you to use its provisions to minimize the tax liability instead of indulging in the act of tax avoidance and tax evasion. So all these provisions, all these deductions, section 54, 54B, 54D, 54EC and 54F are designed to provide relief to the taxpayer, provided he meets the conditions which are specified in these sections. So in today's class, probably we will discuss the first two sections, which is section 54B and section 54D. Now, to begin with, I want to tell you the secret as to what is common in all these sections, because you shouldn't get carried away by looking at these sections and think it's quite complex for you to remember or to understand. In fact, they are quite easy and quite simple to remember, quite easy to understand. So what do you have common in all these sections? So let me reveal what's the commonality in all these subjects, all these sections. Now, all these sections offers deduction, right, on a certain condition. And the condition is quite simple. The assessee should sell something, and from the amount of profit what he has earned by selling that capital asset, he should reinvest it somewhere else. So that's the simple logic behind all these deductions. Logic is the gross capital gain which is made by the assessee by selling the capital asset has to be reinvested somewhere else. If the assessee does the reinvestment, reallocates that profit what he has made from capital gains, he is entitled for deductions. So that is something which you would find common in all the sections. All the section says you have to sell so and so capital asset, and the profit what you make from that capital asset has to be reinvested somewhere else. So that's the funda or logic behind all the deductions. So in all the deductions, you have something that needs to be sold and something that needs to be bought, right? So that's the common point behind all these deductions. So what does section 54 says? As I mentioned, you have to sell something, right? So what needs to be transferred? What needs to be sold? It's already mentioned here. So section 54 provides relief to the taxpayer in the form of deduction if he transfers residential house property. So let's note down what needs to be sold. The answer is residential. And very important, the asset that is sold, residential house property, should be a long-term capital asset. If it is a short-term capital asset, then the assessee cannot claim deduction under section 54. It has to be a long-term capital asset. Now, what is a house property? House property is an appreciating asset. It is an immovable property, and the holding period for immovable property is 24 months. So when we say long term, that means the asset so transferred, or the asset which is being sold, should have been held by the assessee for at least more than 24 months. So if he does that, then it becomes a long-term capital asset. So what needs to be sold or what needs to be transferred is residential house property. Now with this, I told you the funda is that you should sell something, and with the profit what you make, you have to buy something with that. So what needs to be purchased or where the amount needs to be invested, right? So where the profit, or the right word to use is gains, should be reinvested. So the answer to this question is there are two options. Option one, right? Profit should be reinvested, or we can also say what should be bought. So the answer to this question is after the profit what you have made from selling the capital asset, this profit should be reinvested in these items. So first, after selling that residential house property, you should buy one more house property, also referred as new residential house property. Option 2, deposit the amount in capital gain scheme. This capital gain scheme is like a deposit scheme offered by all nationalized banks. Or you can do a combination of both. Keep see all that profit what you have made right here. Some amount you buy a house property and some you invest in the capital gain scheme. The choice is yours. Or you do either one of this, or you can do both, right? So this is what you have to understand, that all the sections have one thing in common. You should sell something, and the profit what you gain from selling the capital asset, you should buy something. So that's the logic behind all the deductions. So what does section 54 says? The asset transferred or sold should be a residential house property, which is in terms of, which is actually a long-term capital asset. And with that money what you have made from transferring the house property, with that money you have to either buy a new residential house property, or you have to deposit the money in capital gain scheme, or you can do a combination of both. The choice is yours. Now the question is, what is the duration given for buying the new house property? How long should you take it? So that also something which you guys have to remember. So in case if you want to purchase a new house, the answer is, if you want to purchase a new house property, the duration, the timeline given is, for purchase, it can be 1 year before or 2 years after the date of transfer. Assuming that this house property is sold in the year 2020, that means I can claim exemption had I bought the property in the year 2019 itself, 1 year before, or I'll be given time till 2022 to buy a new house. So that's the time frame given by the income tax department, either 1 year before or 2 years after the transfer of the house property. But what if you say, no, I don't want to buy a house, I want to construct on my own? For that also the option is available. So if you want to construct your own house property, then you are given 3 years time to do so. So that's the condition. Either take 1 year or 2 years before the transfer to purchase the house. And in case if you want to construct the house, you are given 3 years duration from the date of transfer, right? So these are some of the important conditions pertaining to section 54. So section 54 says an assessee can claim deduction under section 54 provided he transfers a residential house property, and the gain realized from that residential house property needs to be reinvested either in a new house property, or deposit the money in capital gain scheme, or do a combination of both. So if you want to buy a residential house property, you're given time frame of either 1 year before the transfer or 2 years after the transfer. But if you want to construct, then you are given 3 years time frame. Now there is also an important clause that after buying new house property, let's say somebody buys it for the sake of claiming deduction, what is the duration that he needs to retain it? Let's fill up this. Let's assume that I have sold an existing house for 75 lakhs. Okay. And expenses on transfer is 1 lakh. Fine. So this is my net sale consideration. And let's assume my index cost of acquisition is 34 lakhs. So there is no improvement as such. So improvement is nil, right? And the profit what I've made from this is 40 lakhs. So on this 40 lakhs, imagine I have to pay a long-term capital gain tax, right? So in order to save on that long-term capital gain tax, what should I do? I can take the benefit of these deductions. So in my case, I've sold residential house property. So what I'm doing is simple, right? I'm buying a new residential house property. With this money, I'm buying a new house. Okay, so I'm buying a new house. So at what price I'm buying this new house? Let's assume I'm buying this new house by spending 30 lakh rupees. Okay, so in that case, what will happen now is, in this scenario, what will be my taxable capital gain? My taxable capital gain would be 10 lakhs. Okay. So instead of paying tax on 40 lakhs, now I end up paying tax only on 10 lakhs because I have reinvested 30 lakhs in a new house. Right. So this is how I'm saving capital gain tax by reinvesting the money as per the provisions of section 54. But let's say in order to avoid paying tax, what I do is I also deposit in capital gain scheme another 10 lakhs. So what will happen to my taxable capital gain? Taxable capital gain will become nil. Or assume the value of my new house is actually 39 lakhs. Okay. But anyways, I've deposited more money in capital gain scheme. So what will happen here? My tax liability will still be nil. Taxable capital gain will still be nil. But sometimes what students do is they get confused. Okay, 40 lakhs minus 49 lakhs is minus 9 lakh. So they end up writing minus 9 lakh here, which is incorrect. So this is where you guys have to pay attention, right? The question here is, I have made 40 lakh rupees profit. Have I reinvested this 40 lakhs? If I have done so, then my taxable capital gain will be nil. That's it. Don't write a negative amount here, right? Because you have utilized your 40 lakh rupees. So you don't have to pay any kind of taxable. You don't have any taxable profit on which you have to pay capital gain tax. So your capital gain tax will be nil. This is point number one. Point number two, right? Just to claim the tax benefit, I bought this house. The moment I claim the tax benefit, what if I immediately sell this? So that is where income tax department has put a clause that the new house what you have bought, you should keep it for at least 3 years. So you should have this new house which you have purchased to be retained for at least 3 years. Simple. Provisions are simple. Right? But what if I sell this within 3 years? Then the answer is whatever claim I have done in the form of deduction, this will become taxable. So this 39 lakhs, which I have claimed as deduction in the year of sale will become taxable. Simple, right? So these are all the possible outcomes of section 44. Right, so let me quickly recap section 44. So section 44 provides deduction for all those assessees who transfer a residential house property which is long term, and with that money what they have realized from the sale of residential house property, the profit, the gross capital gain what they have earned has to be reinvested either in a new house or in capital gain scheme. The amount needs to be deposited, or it can be a combination of both. Okay, so in order to buy new house, you are given an option. In order to acquire new house, you can either purchase the new house either 1 year before the transfer or 2 years after the transfer, or take 3 years for construction from the date of transfer. In case if you sell the new house within the 3 years, the year in which you sell the new house, right, all the deduction what you have claimed in the past will become taxable in the year of sale, right? So these are some of the provisions of section 54. Now let's quickly move on to the question which is there in your study material. I want you to look at the question in your study material. It's I think it's on page number 12. Anyways, I'll just put the question here. Section 54. And meanwhile, in case if you have any questions, doubt on section 54, please ask me, don't be quiet. Any clarification you have on section 54? Anybody? Okay, so let's go ahead and solve this. So write the opening statement, computation of capital gain of Mrs. Rashmi So the procedure and the format would remain same. First thing we have to figure out is sale consideration. At what price the property is sold. So Ms. Rashmi, a resident of Bangalore, purchased a residential house on 17th October 2000 for 10,26,000. She has done some improvement. So first she constructed a room on the ground floor in the year 2001 for 80,000. Then she also added 2 more rooms in the year 2003 at a cost of 1,20,000. She sold the property on 13th March 2020 for 48 lakhs. So this is the sale consideration, 48 lakhs. And she has also paid or incurred brokerage of 1%. 1% brokerage is your transfer expenses. Brokerage of 1% on what? On the sale consideration. So on this, she has paid the brokerage. So that will be how much? 48,000. Now, when you read the next sentence, it says after selling this house property on 25th March 2020, she has bought a new house for 32 lakhs and she has also made a deposit in the capital gain scheme. So that's the first thing you have to do whenever you see SSC, whenever you see the SSC has done some sort of reinvestment, right? So immediately you have to figure out by looking at the question, because you will have multiple deductions in the future, right? Right now we have only, we are discussing only 54, but moving forward, you have to remember so many others also. So you have to always see what is being sold and what is being bought. Now, the moment you see what is being sold is a house property and what is being bought is also a house property, then you can easily come to a conclusion that this is a deduction which the SSC can claim under section 54. Right? So 54 says you have to sell residential house property and with that money you have to buy a new residential house property, and the duration is also specified. In case if you're buying, you have to buy within, right, time limit is given either 1 year before the transfer or 2 years after the transfer. In case if you're constructing, you can take 3 years. But what has happened here, the SSC has sold the house property on 13 March and within few days itself she has bought a new property by spending 32 lakh rupees. So she is right, done everything as per section 54 and therefore she is entitled to claim deduction under section 54. Right? So we have to apply the provisions of section 54. So let's deduct the transfer expense now. So the end result of this step is called net sale consideration, which will be 47,52,000. So from this, less index cost of acquisition. So how did we come to conclusion that we have to take index cost of acquisition? Because this is a long-term capital asset, right? House property is an appreciating asset. Under appreciating asset, it is an immovable property. Immovable property, the holding period is 24 months. So the asset is bought on 17th October 2000 and it is sold on 31st March 2020. Obviously, the SSE has held the asset for more than 24 months and therefore it is a long-term capital asset, right? And for long-term capital assets, we should take index cost of acquisition. And in index cost of acquisition, as you know, there are two equations. Which one needs to be taken? The first or the second? How do we decide? If the asset is bought before 1st April 2001, we have to use equation number 1, in which we do a comparison between cost of acquisition and fair market value. If the asset is bought after 1st April 2001, then we have to take equation number 2. Now, since the asset is bought before 1st April 2001, so we use equation number 1, which goes like this: cost of acquisition or fair market value as on 1st April 2001, right? And we take whichever is higher. So take whichever is higher, divided by 100, divided by 100 into CII of previous. That's the equation. So let's substitute the values from the equation now. So ICOA is equal to, what is the cost of acquisition of the house? Cost of acquisition. The house was acquired on 17th October for 10,26,000. So that's the cost of acquisition. And what is the fair market value? The fair market value of the house on 1st April 2001 was rupees 10 lakhs. So let's write down the fair market value of the house now. And now we take whichever is high. Obviously, 10,26,000 will be higher. So we take this divided by 100 into CII of previous year. If assessment year is 2021, previous year will be 1920 and the CII of previous year is 289. So let's write down the CII. So 10,26,000 divided by 100 into 289. So this will give you 29,65,140. So this is our indexed cost of acquisition. The house has gone through 2 improvements. Which you guys can see here in the question. Combination of next, determination of index cost of acquisition. So there are 2, in fact, there are 2 index cost of acquisition in this. The first one was in the year she constructed a room on ground floor in Jan 2001. Was in Jan 2001. First improvement was done in the year 2001. What does the rule says? The rule says any improvement on or before 1st April 2001 should be ignored. That's the rule. We have already done this. We have done similar kind of questions in the past. So this is just to recall that any improvement done on or before 1st April 2001 should be completely ignored. Only improvement done after 1st April 2001 should be considered. And that's what we are doing here. The first improvement needs to be ignored. The second improvement can be considered. So index cost of improvement is equal to cost of improvement divided by CII of the improvement year multiplied by CII of previous year. Let's calculate the amount now. So CII and cost of improvement. So cost of improvement is how much? 1,20,000. And what is the CII of improvement year? Improvement year is 2003 and 2003 and 4 the CII is 109. Cost of improvement divided by CII, which is 109, multiplied with CII of previous year, which is 289. So let's simplify this. 1,20,000 divided by 109 into 289. So this will give you 3,18,000 165. 165. So now we have all the required data to compute gross capital gain. Gross long-term capital gain. So deduct both the amounts from NSC, net sale consideration, which is 47,52,000, minus index cost of improvement, which is 29,35,140, minus index cost of improvement, only the second improvement, 3,18,165. So you get 14,98,695 as your gross capital gain. Now, the next step is something we are doing new for the first time. Less deduction under section 54. In fact, there are two, right? Because she has done both. Purchase of new house property. So how much money did he spend to buy? I mean, she has spent to buy a new house. So Ms. Rashmi has spent 32 lakhs to buy the new house. Has she bought the new house as per the time frame given by the provisions of section 54? The answer is yes, because it says for purchase you have to buy within 1 year before or 2 years after the date of transfer. But she has bought within few weeks itself, right? So she is entitled for a deduction. She has spent 32 lakh rupees to buy a new house. And she has also deposited capital gain scheme. How much? She also deposited 1 lakh in capital gain scheme. So 1 lakh is what she has deposited. So these two things needs to be deducted from gross capital gain. So once you deduct these two things, the taxable capital long-term capital gain will be nil. That's what I said. Don't end up writing a negative amount there. She has made a profit of 14 lakhs 98,695. Has she used this profit as per section 54? She has. And after using that profit, anything is left out? The answer is nothing is left out. So taxable long-term capital gain will be nil. Don't write a negative amount. Don't write 14 lakh 98,000 minus 33 lakhs and write the negative amount. No, all you have to see is whether this is being reinvested or not. If this is reinvested completely, then there's nothing left. So there is no taxable capital gain at all, right? So this is how you should compute taxable capital gain by applying the provisions of section 54. In fact, for all the provisions, the concept remains same. The logic remains same. You should sell something and the amount realized from the profits realized from the sale of capital asset should be reinvested somewhere else. So that's the logic behind all the deductions which we would be doing in the coming classes also. So any doubt, any confusion, any clarification, go ahead.